So consolidated statements, or group accounts as they're usually referred to, seems to be an area of the financial statement syllabus that gives students more problems than most. And I'm going to cover those in three sections. This first video is just a basic introduction to what group accounts are all about, and then I'll have another video looking at how the consolidated profit and loss accounts put together, and then a final one on the statement of financial position, the balance sheet, how that's put together. The exam questions tend these days to be based on calculations of individual figures within the financial statements, rather than the preparation of a complete set of accounts. I guess that's because in the past it's sometimes been possible to work out some of the important figures just as a balancing figure to get the balance sheet to work out, and that's not what AAT want. They want you to understand how the figures arrived at. So these days in the exam, you're more likely to get questions asking you to calculate individual figures that appear in the accounts, rather than prepare a complete statement. So this presentation will deal with a bit of the background, the relevant accounting standards, and so on, and then we'll launch into the calculations. And as with ratios and most other things in the exam, practice is the answer. The adjustments, particularly in the case of the statement of financial position, the adjustments are fairly consistent from one question to another, and so practice is the key to getting them right. So first of all, we need to understand what a group is, and why a group might exist in the first place. And when we're talking about a group of companies, we're referring to more than one company where control of those companies rests with the same individual or group of individuals, and that's an important word to remember, as you'll see later on, is control. So if you've got more than one company that's controlled by the same individuals, then you've potentially got a group there, as we'll see in a moment. And there are several reasons why business activities might be divided up between separate companies, even though they're under the same ownership and control. First of all, separating out a high-risk business, so that if that business fails, it doesn't affect the rest of the organization. Maybe some businesses you'll want to carry out in partnership with others, but you don't want them to share the risks and rewards of all the businesses that are being carried on. There may be some reasons for splitting businesses up from a tax point of view. You might have businesses run by different sets of directors, and you don't want them to be directors and have a say over all of the businesses that you own. Presenting a different image to customers. Very often in the high street, you'll see what appear to be competing shops that are actually owned by the same company at the end of the day. That used to be the case with Currys and PC World. You might have thought that they were competing with one another, whereas in fact they were both owned by the same group of shareholders, and so on. So here's an example. We've got a shareholder there, Mr. X, who owns all of the shares in a particular company, and that company carries on 5 different activities. And he may want to split those activities up. So maybe A and E will stay in that main company, but B might be a business that's a high risk. There might be some possibility that business will fail. If that happened within the single company, then all of the businesses would be affected, and that company may well have to fold up totally. But if that high risk business is incorporated into a separate limited company, remember each limited company is treated as a separate individual legally, then although B Limited in this example might go bust, then A and E could still carry on trading unaffected by that. We might split off activity C into a separate company, and that may be because we've got different directors running that business, making decisions and so on, and we don't want them to have an input into any of the other business activities. So if we've got Tesco's run supermarkets, but there's also Tesco's Bank, Tesco's Insurance and so on, and it's likely that the banking activities that Tesco carry on are run by different people with experience in that field. They really don't know much about how supermarkets operate, so it would be inappropriate for them to have any input into the decision-making process as far as the supermarkets are concerned. So we might want to split activities into different companies for that reason. And maybe activity D in this example is carried out with the input of other shareholders in a kind of partnership activity, and we don't want those other shareholders to have any share of the profits from the other business activities being carried on. So there's lots of reasons why, instead of all of your business activities being carried on in just one company, that we split them up into different ones, and that gives rise to what we term a group of companies. And here we've got the company at the top that Mr. X owns the shares in. That's referred to as the parent company or the holding company, and these other three companies, B, C and D, are referred to as subsidiary companies. Now there's just one thing we need to be clear about as far as groups are concerned. Here we've got Mr. X with shares that he owns directly in A Limited. That's the parent, or sometimes referred to as the holding company of the group, and that company in turn holds all of the shares in B Limited and in C Limited, and those two companies are referred to as the subsidiary companies. Now that makes up a group, and although A Limited owns all of the shares in B Limited and C Limited, all three of those companies are owned by Mr. X, and ultimately Mr. X has control over all three because he can decide what A Limited does, and therefore he can instruct A Limited as to what decisions A Limited makes regarding B and C Limited. So Mr. X has control over all three indirectly, and that constitutes a group of companies. Now it's possible that Mr. X might own the shares in A Limited and own the shares in B Limited directly, and also own the shares in C Limited. Now in either of these two cases, Mr. X does own all three companies one way or another. But in the second example here, that does not constitute a group. We only have a group of companies, and we only have a need for group accounts where we've got one limited company owning shares in other limited companies. If Mr. X or the other investors own the shares directly in each company, there's no need for group accounts. It's only this first arrangement on the left-hand side of the slide where we need to produce those consolidated financial statements. So here we have a small group of companies, parent company A Limited and two subsidiary companies, B Limited and C Limited. Now each of those companies, because legally it's a separate entity, each of those three companies will produce its own financial statements, and they'll be filed at Companies House as with any other company. Without group accounts, the shareholders who own the shares in A Limited, the parent company, wouldn't automatically be entitled to copies of the accounts of B Limited and C Limited, and so they could be missing some information, although obviously these could be obtained possibly from Companies House depending on the size of the company. But more importantly, profits could be easily overstated if transactions are carried out between any of those three companies. We'll just have a look at an example to see how that might happen. So here we have our small group, and if we look at B Limited, the subsidiary, maybe B Limited buys goods from an outside supplier for £4,000, and B Limited might then decide to sell them to A Limited for £6,000, and in B Limited's own financial statements will be showing a profit of £2,000 after that transaction. A Limited has now purchased those goods from B Limited for £6,000, and maybe A Limited then sells them on to C Limited for £8,000. And so A Limited is now in its own financial statements also showing a profit of £2,000. C Limited purchases the goods from A Limited for £8,000, and then maybe it sells them back to B Limited for £10,000. And so in C Limited's financial statements, will be showing a profit of £2,000, and at the end of the year B Limited will be showing in its statement of financial position year-end stock of £10,000. So if we look at the individual accounts, we might be led to believe that we've made a profit during the year of £6,000. But if we own all three of those companies, if we own A Limited, B Limited and C Limited, then in actual fact we've made no profit at all. The reality is that the goods that B Limited originally purchased for £4,000 are still on B Limited's shelves at the end of the year. The only difference is that we've now valued them at £10,000, and so we've artificially generated a profit of £6,000. And clearly, if we own all three companies, that's not true. That's not true. And so the group accounts eliminate all of those intercompany transactions and show us the true position of everything that we own in terms of trading companies. So, to present a true picture to the investors of how well their businesses that they own are doing, we need to present a set of single consolidated financial statements which attempt to show the profits and the assets belonging to those investors as if all activities had been carried on by just one company. And so all of those transactions that we looked at in the previous example, apart from the original purchase of goods from the outside supplier for £4,000, all of the other transactions would need to be eliminated. And that's the first thing we would need to do when we start to prepare the consolidated financial statements. So any intercompany sales, any intercompany purchases, those need to be eliminated from the figures entirely, because if all transactions had been carried on by just one single company, those entries wouldn't appear. We also then need to cancel out any intercompany payables and receivables that are in the year-end statement of financial position. In this case, one company will be showing money owed to it, and another company within the group will be showing a liability of equal amount. And both of those balances need to be cancelled out. So those are the basics that we'll need to do when we come to produce the consolidated financial statements. The adjustments do start to become more complex than that, particularly where an existing company has been purchased and becomes part of the group after it has been trading for a while. Then the adjustments and the calculations get somewhat more difficult, and we'll be looking at those in future presentations. Let's see now then what the accounting standards have to say about it. First of all, the conceptual framework document deals with consolidated and unconsolidated financial statements and sets out the main rule there. Consolidated financial statements provide information about the assets, liabilities, equity, income and expenses of both the parent and its subsidiaries as a single reporting entity. In other words, as if all of the assets were owned by a single company and all of the trading activities were carried on by one single company. And the framework goes on to say that this information is useful for existing and potential investors. They have overall ownership of all of the companies included. As far as accounting standards are concerned, there are two that are relevant to group accounts. IFRS 3 deals with business combinations, and that sets out the rules for dealing with the acquisition of an existing business. So if, for example, Jaguar buys out Land Rover, that's an existing separate limited company, IFRS 3 sets out details of how that acquisition needs to be dealt with. And in particular, it deals with how to calculate goodwill. And goodwill's one of the most important things as far as the exam is concerned. There'll be lots of marks available for accurately calculating the goodwill figure in respect of an acquisition of an existing company, and that's something we'll look at in detail when we come to look at the consolidated balance sheet. And it also contains disclosure requirements for those acquisitions. IFRS 10 sets out in detail how the consolidated financial statements or group accounts are actually put together and which companies to be included. and that's an important thing to consider. Just because one company owns shares in another company doesn't necessarily mean that there'll be a requirement to prepare group accounts for those companies. It all depends on control, and that's contained and detailed in IFRS 10, and that's one of the important key words to remember when it comes to group accounts is control. Just to mention, there's also another standard dealing with associated companies and joint ventures. This won't crop up to any large extent in the exam, but companies which aren't treated as group companies need to be accounted for in a particular way if we have influence over that company's affairs. We'll maybe talk about that a bit later on. So if we just look in a bit more detail at the rules contained in IFRS 10, IFRS 10 requires a parent company to present consolidated financial statements, which includes all of the other companies that that parent company controls, and they're referred to as subsidiaries. And as the slide says there, this enables investors to get an overall view of the business operations of the economic entity, the whole of the activities carried on. And here's the important thing to remember: the accounts have to reflect all of the assets, all of the liabilities, and all of the profits and the trading activities of companies which are under the control of the same ultimate shareholders, even if those shareholders don't own 100% of those companies. That's the most important thing to remember. And there's an example: if A Limited owns 75% of B Limited, then we don't just include 75% of B Limited's profits, we don't include 75% of B Limited's assets and liabilities, we include all of them, 100%, even though legally we only are entitled to 75% of those. And how do we deal with the difference? In the balance sheet, as we'll see in due course, the part of those assets and profits that belong to other people will be reflected in a minority interest figure that appears as a balancing figure in the balance sheet, in the statement of financial position. So when you think about the double entry, we're including 25% of the asset value that belongs to somebody else as a debit to the asset accounts. That's reflected in a credit to the minority interest account, basically. So that appears in the equity section, and that reflects the part of the company's profits and assets that we've included, even though we don't own them legally, we do have control of them. So really important point to remember: the accounts reflect the total value of assets and liabilities and total profits made by companies under the control of the parent company, not necessarily owned by the parent. Now, IFRS 10 contains some definitions, and the most important of those is control. And there's the definition there from IFRS 10. An investor controls an investee, the subsidiary company, when it's exposed to and or has rights to variable returns, i.e. returns dependent upon profits, from its involvement with the investee, and has the ability to affect those returns through its power over the investee. In other words, it can control, it can tell the subsidiary company what to do. And the subsidiary defined there is one limited company controlled by another limited company. The parent company is one that has control, and the group refers to a parent company and all of the subsidiary companies under the control of that parent company. So control is defined as being able to affect what the subsidiary company does, and there are many ways in which control can be exercised. In the exam, then, we're looking at more than 50% of the ordinary issued share capital. Any individual or company that owns more than 50% of the shares has control. It can choose to hire and fire directors at the annual general meetings and agree on dividend payments and so on. It has control over what the subsidiary company does. So more than 50% of the issued ordinary shares indicates that the person owning those has control of the company. There are other ways in which control can be exercised. I'm just listing them there. Don't worry too much about them. In the exam, the important thing will be that we own more than 50% of the share capital. But you could be asked for what else might indicate control, and there's some suggestions there. Now here's a real life example of a group, quite a substantial one. HSBC has probably changed a bit since this diagram was produced. As you can see, it's some time ago. But HSBC Group PLC, that's the parent company, and that company owns more than 50% of this company. That's a subsidiary, and if that subsidiary company then in turn owns more than 50% of another company, then indirectly HSBC Group has control of both of those, because the HSBC can tell the first company what to do, and therefore it can tell it how to direct the company that it in turn has control of. So the group company HSBC has indirect control over all of the companies in that diagram, and consequently the consolidated financial statements of HSBC have to include all of the assets, all of the liabilities, all of the profits and all of the losses of all of the companies shown there. And in real world situations, that's quite a complicated task, and there is specialist software available to help in that consolidation process. You'll see when we come to the consolidation of the profit and loss accounts and the balance sheets how complicated it can get, and if you think of the number of companies that HSBC controls, it's quite a task in the real world to produce those group accounts. So that's just a brief introduction, just to give you an idea. And important things to remember: when we talk about a group of companies, we're referring to companies referred to as subsidiaries that are under the control of a parent company. So it's one company having control, more than 50% of the shares of another. And control can be exercised in different ways, but usually, certainly in the exam, we'll be looking at more than a 50% shareholding. And then the other important thing to remember is that the consolidated financial statements will include all of the profits of those subsidiary companies that we have control of, and all of their assets and all of their liabilities, even if the parent company only legally owns less than 100% of that subsidiary. Now, in the next slides, next set of slides, we'll be looking at the profit and loss account and how the consolidated profit and loss account is put together, the income statement, and then we'll have another presentation on the consolidated statement of financial position, the group balance sheet.